Join me in this video as I crack the code on small cap stocks before they take off much further. Over a month ago on June 23rd, I published this video and predicted that small cap stocks were likely to start moving higher soon. Well, since that time, that's exactly what has started to happen. But let's take a look at how small cap stocks have performed in the past and discuss if you should consider including them as a shorter term profit generator in your portfolio. The real question is, do small cap stocks provide better returns than the S&P 500 over the long term, or do they present short-term trading opportunities to boost portfolio performance? To better understand this, let's take a look at the history of the S&P 500 large cap stocks and the Russell 2000 small cap index, and then we'll look at the sell-offs and rallies in both of these indices to see how they've compared. Look, the first thing you'll notice is the higher risk small cap stocks shown here in orange, or the Russell 2000, have performed about the same over all this time as the lower risk large cap S&P 500 stocks shown in blue over the long term. Look at this. They pretty much kind of neck and neck track each other, trading places here every now and then over this entire period since 1987. So why is this? And shouldn't higher risk small cap companies like the ones in the Russell 2000 outperform the lower risk large cap companies in the S&P 500? Well, two things. Neither of these graphs includes dividends, so that will have some effect on it, but I don't think that effect will be big enough to change this outcome very much. If you stop and think about it, small cap stocks are currently limited to a maximum of $2 billion in market capitalization, or market cap. This causes the more successful companies to really get kicked out of the small cap category and therefore out of the Russell 2000 index. Where do they go when that happens? Well, they leave the small cap index and become part of the mid cap category, which currently starts at $2 billion and goes to $10 billion. The second thing you'll notice is small cap stocks are much more volatile than the large cap stocks in the S&P 500. So why would anyone invest in small cap stocks? My opinion, you should not invest in small cap stocks over the long term. Small cap stocks represent a shorter term trading opportunity with a time horizon of, let's say, 1 to maybe a maximum of 4 or 5 years in most cases, right after the market has bottomed out. And to show you that, let's take a look at this table where we can see what small caps have done after bottoms in the market. And I've listed the date of the market bottoms here and where the S&P was and where the small caps were. And what we really care about here are these returns over here all the way on the right. So in this table, you can see where small cap stocks have outperformed. I've highlighted the ones that are outperforming in green. You can see where they've outperformed 11 out of 12 times here. I'm not including this last one, and we'll talk about that. But 11 out of 12 times, small cap stocks have handily outperformed the S&P 500 coming off of a bottom. And by the way, this last one, we're currently coming off the latest bottom in the markets where the rally in small cap stocks is just getting started, as I showed you in some of those previous charts. And small cap stocks are currently underperforming large cap stocks. So where does this all leave us? Well, small cap stocks should continue to benefit greatly once the Fed starts lowering rates, most likely in a couple of months when they meet in September, and we'll talk about this Fed rate monitoring tool later in this video. As I've said in my previous videos on this subject, if you want to try and make some shorter term profits on small cap stocks in the next 1 year or more, dollar cost average into the ETF IWM and or ARK Invest's ARKK to take advantage of lower interest rates when they start to come down, hopefully in the next few months. But in the case of ARKK, this is not a pure small cap play. This is an innovative ETF investing in innovative companies, many of which are small companies. Some are very large companies. So ARK Invest may outlast the small caps in terms of continuing great returns. The hard part's going to be to determine when to start selling small caps and shifting your profits and small cap positions into larger cap companies. If you found this video helpful, it really helps my channel if you like, subscribe, and share this video with your friends. This helps me continue to create future videos with insights into the stock market dynamics and profit-generating ideas. With all that, let's go through the current health of the stock, bond, gold, and crypto markets. Well, if we take a look at equity performance over the past week, over the past 5 trading days, you can see we've got an interesting bifurcation here. You've got small caps now on top, the Dow in second, and then you've got the S&P, ARK Invest, and NASDAQ all with negative returns over the past 5 trading days. This is totally flipped pretty much from where it was. And if we look back over the past month, you can see that small caps have continued higher while ARK Invest has waned a little bit. The Dow's kind of here in the middle, and then the S&P and the NASDAQ are both underwater. But if we look at year to date, you can see that the NASDAQ's still pretty much on top, but you can see that small caps are shooting higher, and if they continue, could end up passing the S&P and the NASDAQ, but we don't know where this is going to go. And then here's the Dow, and then ARK Invest is way down here. So ARK Invest, when it launches, it really has a long way to go to beat all of these out. And I do think it will happen. And then if we look back over the past year, you can see that we've had a very nice rally in the NASDAQ, the S&P. Small caps are now coming up here and starting to look better than the Dow. And ARK Invest is still kind of lagging behind here. And what about the current bottom dynamics? Well, this has been a really interesting picture. In fact, last week I talked about the fact that the confidence level was just about at zero here, bouncing around near zero. It was negative back here. And what this tells me is there's really no herd behavior. But look at what started happening. There's more of a herd behavior here. Now, it started happening as the market was dropping, so people were getting out of things pretty much in unison. But now the market has turned around and started to go higher. And if this confidence level continues higher and this market confirmation signal, the blue line, continues higher, this will be great for stocks. And what about risk versus opportunity? Well, you can see that the risk acceleration really just plummeted below 10. Now it is rising here, but I don't really get concerned until this gets well above 50, in fact, preferably 60. So this is a long way from that. And now I'm not saying it won't get there, but right now I'm not concerned about it. I don't like the direction it's going, but as long as it stays below 50 or 60, I'm somewhat comfortable. Now, in combination with that, I don't like the fact that the opportunity acceleration is also plummeting. So this is going up, this is going down. If that continues, that's not good. Now, if we look at risk, the red line, this is a very laggy indicator, and you can see that it's just been declining, and it's now down here below 30. So this is a very low level for this. And the opportunity level, this blue line, is up here in the mid to high 70s. So this is a very good picture right now. And how does this show up in equity versus safety? Well, let's jump right into the overlays. You can see we've had a real paradigm shift here. We had the NASDAQ 100 up here in first place, and then it just plummeted. In 2 weeks, went from first place all the way to last place. Similar picture with the S&P 500. It went from second place down to ninth place. So the S&P and the NASDAQ have just collapsed here in the equity versus safety rankings. And you can see what's been happening with small caps, though. Went from 10th place right up to first place, where it's been for the last couple of weeks. Now, interestingly enough, the Dow has moved up from 4th to 3rd to 2nd. But what I really don't like about this graph, I don't like the fact that cash is now moving up and is in 4th place. I don't like cash being in the top half of this table. That's not giving me much comfort here. And what's been happening on the safety side of things? Well, I like the fact that gold is pulling back here a bit in the rankings. Like I said, I don't like the fact that cash has moved higher and the intermediate treasuries have moved higher and that long bonds have moved higher and that very long bonds have moved higher. This could be considered a flight to safety. Now, what I do like about this is I like the fact that intermediate bonds are ahead of short duration bonds down here, and 20-year bonds and long bonds are also ahead of short duration bonds. So if these continue to move and EDV flips above TLT, we'll have a healthy treasury risk appetite. I just don't want to see these all up here in the top half of the graph. That means we have a bad equity risk appetite. How does all of this show up in the buying and selling pressure? Well, you can see we've had a very nice rally going here in the Dow, which kind of fell apart and now is starting to go higher again. You can see that the buying pressure peaked out here and has been declining, but it has turned around. So hopefully next week, this will continue higher as the price continues higher. S&P 500, same picture. And you can see that the buying pressure is pointing higher, but the selling pressure is quite a bit above the buying pressure. And you saw that in equity versus safety with the S&P down in 9th place. What about the NASDAQ 100? Just like the S&P, declining prices, selling pressure going higher and well above the buying pressure, which again, kind of goes along with the fact that it's ranked 10th in equity versus safety. What about small caps? Very nice, somewhat of a hockey stick rally going on here. And you can see we had a huge spike in buying pressure, which I knew could not sustain. It fell back and now is pointing higher again. So it'll be interesting to see what happens with these over the next several weeks. And then what about ARK Invest? Well, ARK Invest had a very nice rally. And just like the rest of the indices, it peaked out and has pulled back, but started to go higher over the last couple of days. And the buying pressure is moving higher, and it is currently above the selling pressure, which is this orange line. Now let's take a look at sector rankings. And you know, if you've watched my videos, these move very slow. These are very much a lagging indicator and a look in the rearview mirror. And you can see that, you know, technology over the last couple of weeks has been ranked 1, 2, and 3 up here, along with clean energy, which is a play into all the power it takes to power AI computers. So this is very good, and consumer discretionaries up here. So this gives you a very nice picture of the market in the rearview mirror. But let's go to sector rank acceleration. This gives you a shorter term view and kind of gives you an indication of where things might be headed. And let's just jump right into the overlays. So if we look at the overlays, there's a lot of goodness here. You can see a lot of green lines. So you can see emerging companies, small caps, IWM, moved up nicely. You can see ARK Innovation moved up nicely. QQQJ, which is the smaller companies in the NASDAQ index below the NASDAQ 100, moved up very nicely. The Dow moved up. You've got Bitcoin moving up. You've got clean energy really moving up. And again, this clean energy is a play into the power needs of artificial intelligence, which is technology, up and coming technology. And I put a green line on consumer staples moving down because I think in this case, consumer staples are moving down because investors, or traders as I would call them, are taking their money away from the consumer staple stocks and putting them into some of these other areas like small caps. Now, what about the yellow lines? Well, I made these yellow because the technology stocks, NASDAQ 100, Semiconductor Index, and XLK, which is a technology ETF, have all stayed put. They haven't gone down. So I'm encouraged by the fact that they are staying put, and hopefully they'll turn around and start to move up next week. And what do I not like? Well, not too much. Consumer discretionary slipped down. That's not a positive. The S&P 500 really dropped, as we saw in equity versus safety. That's not good. And then cash moved up. That's not good. And I don't like the fact that gold is moving up in the rankings. Now, you could argue that's just its own thing and it doesn't matter. So, but I put it on here as a kind of an orange line just to keep a tab on it. And what about treasuries? Well, you can see we ended the week with not a healthy relationship. We have the longest duration treasuries, TLT and EDV, with losses for the week. And then the shorter duration treasuries are positive for the week. So this looks like it's not a healthy appetite for treasury risk. But if you go back here to where they bottomed out, you can see that EDV, this purple line, and TLT have been moving up at a very nice slope rate while these are kind of flat. So this is starting to look good. What about over the last month? Well, over the last month, you can see a very rocky ride. We had a nice rally here, a pullback, and now another rally attempt. What about year to date? Well, we're still well underwater with long duration treasuries. And then if we look back over the past year, again, we're still well underwater with long duration treasuries. So EDV is almost 11% under where it was a year ago. So it's got to go up, probably 12, 15%, something like that, just to get back to where it was a year ago. And how does this show up in the buying and selling pressure for treasuries? Well, as you saw in the short duration treasuries, they've done pretty well. You can see the price action has been very steadily higher. You can see that most of the time here, the buying pressure, this gray line, was well above the selling pressure, and now it's shooting higher as the selling pressure falls off. Intermediate bonds, not as rosy of a picture, but the price action has been generally up. You can see that there was some selling pressure here, so it's kind of trending down. You had what could have been a divergence here where the selling pressure was moving higher as the price was moving higher. And you know what? This did pull back a little bit, but then turned around and headed higher. What about 7 to 10 year treasuries? A little bit rockier of a ride, but in general, an upward price movement. More flat recently, flat to down. And you can see that the buying pressure is moving higher here at the end. And then long bonds, 20-year treasuries. You can see that this has been a pretty rocky ride, mostly flat. And you can see that the selling pressure has been increasing lately. So this is not necessarily good for treasuries, although I like the fact that the price moved up over the past couple of days. And you can see that the buying pressure moved up with it. And what about that inverted yield curve? Well, last week, I think we were 14 basis points inverted. Now we're a little bit more inverted at almost 20 basis points right here. And you can see that a year ago, the light blue line, we were much more inverted than we are now. So the dark blue line is where we are now. And you can see that interest rates at the shorter end have been dropping. And I think that's in anticipation of the Fed lowering rates in September when they meet. Now, when the Fed starts lowering rates, these will drop a lot very quickly. And speaking of the Fed lowering rates, here's what the current picture says. So they're going to meet next week in 3 days on Wednesday. I'm pretty sure July 31st is Wednesday. And there's almost no chance that they're going to lower rates. 93, almost 94% likelihood that they leave rates right where they are. And you can almost bet on the fact that that's what's going to happen. Now, if we look at September, just a few months out, you can see there's no chance that the rates are going to be where they are now. In fact, there's a 100% chance or likelihood that rates will be lower by at least 0.25%, if not 0.5%, and even a tiny possibility of 0.75%. Now, when we go out to November, you can see that now there's almost no chance that rates will even be down by just 0.25%. 0.5% to 0.75% is kind of where we're looking at. And if this all comes to pass, this is going to have a big effect on small cap and innovation stocks. And what about gold? Well, gold has been doing its own thing here. You can see it just kind of rallied and then kind of like equities started falling off recently. And you can see that the selling pressure has really been launching higher until this last day or two when it started to collapse and the buying pressure started increasing. And what about Bitcoin? Well, Bitcoin had a real tough run here. You can see that. But more recently, and I talked about this last week and the week before, when the selling pressure got up this high, I thought really this downward move was kind of coming to an end. Because when it's this high, it really doesn't usually go much higher than, call it 8, maybe 10. And you can see that's exactly what happened. The price has been moving higher, the selling pressure has been falling, and the buying pressure has been on an increase, which is really nice. As you can see from the price movements and the metrics in the buying and selling pressure charts for equities, the equity markets are trying to recover and move higher after the recent pullback, with the Russell 2000 small caps leading the way. Now, they're not quite above these two yet, but boy, the slope is pretty steep. And treasuries have been trying to recover from their recent pullback. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.